So hopefully you guys can see this. This slide, it should not say less than, it should have been greater than. Okay, so, I mean, I think it was kind of understandable, or at least it's, anyways, I think it's kind of obvious in the examples, but anyways, that was an error. So I just want to let you know that that should have been, that should be corrected. So anyways, so I fixed that one there. And then for the walkthrough, just go through it. Now, how was the homework? How was this week's homework for the class? Not seeing any comments. So just, was the homework long for you guys? Like, was it difficult? Just, again, give me a sense. How was the homework for the group? How was did people find the partial change in use difficult? Like, did the handout I give kind of help? Okay. All right. Well, anyways, let's just go through it and let's see how people ultimately did. Okay, so I'm going to leave that one last for now. In terms of 8.10, 8.11, we'll just go through the other stuff first, and then we'll circle back to the change in use at the end. So the first question we'll go through is 8.11. This one is this one was going back again to change in use, but again, it's a little bit of there's a little bit of other stuff in here. You've got Ellie. She is she's a Canadian resident, but she's assigned to move to California, and they just give you a bunch of information. Okay, so again, if in terms of how you should do things, number one, you want to make sure you identify all the dispositions, right? And the key thing is, and we mentioned this in class, if you are leaving Canada, the real property is exempt from the change in use, or not change in use, sorry, from the deemed disposal rules. And the reason that is because Canada has a whole regime regarding real property. So if you're a non-resident and you sell real property in Canada, you have to go through what we call a Section 116 process. So you actually have to go through an audit process every time you sell real property in Canada. So because of that process, they don't automatically deem you to dispose of real property when you leave Canada. Okay, and the reason they do this is because, of course, real property is typically considered very high value. So this process ensures the government gets every single dollar they're entitled to when you have the sale. Two, again, when you're looking at things, you need to know what type of property you're dealing with, because you need to be certain that any special rules you're going to deal with. And if you take a look at this, you've got PUP and LPP in this question, right? Because you see oil painting, coin collections. And again, this person, there's nothing here about this person doing business. It's just they're leaving Canada. So typically, anytime you see this type of situation, it's very, very typical to have to deal with PUP and LPP. So, of course, if there's PUP, LPP, now you have to make sure you identify your type of property. And you need to ensure, assess, is the floor rule going to apply? So we take a look at each item here. Is there any item where proceeds are less than 1,000? The answer is no. Everything they gave you was over 1,000. Is ACV anything less than 1,000? No, everything's over 1,000. So do you have to worry about floor rule? No, you don't. Okay, so now you sit there and say, okay, we now know our proceeds in ACB. Now let's go and do our calculation. Okay, so if we look at each item, you have, and the thing is, again, anything that's LPP, we want to look at it on the side, right? So if we do all our non-PUP, LPP stuff first, you've got Enbridge, right? So there's your sale. So you're going to have a capital gain. Okay. There's Veresen, another share. That's at a loss. You have Council. Council, they tell you, is a CCPC. Okay. But again, you have a gain. It's just going to be a capital gain. Okay. You have your powerboat. Your powerboat is PUP. So remember from last time, if it's PUP, if the amount is negative, then it'll be automatically nil, right? If you have paintings, and right, so now those are the LPP items, right? So paintings and coins, those are LPP. And remember, the vacant land, the personal residence, those are not automatically deemed to be sold for when you leave Canada. Okay. Now you take a look at this. Oh, for LPP, if you look at paintings and coins, you're an LPP loss. So now you have an LPP loss carry forward. Okay. So there will be no, nothing that goes into 3BIB. No taxable net gain results. You just have this LPP loss carry forward. And again, you keep this gross. You don't apply the 50%. Okay. And that's all you need to do in this question. You were not asked to go further. They just want you to determine any taxable capital gain or allowable capital loss. Okay. Any questions on this one? I think this question was fairly straightforward, with the real estate really being the only wrinkle. So I just see Sarah saying no questions. Anyone else? Just want to get a good wide cross section here. Okay. Can you get an ABLE? Well, what's the trigger for ABLE? What type of share do you have to deal with of Durzak? you have to, so that's not the best. I mean, just giving me that reference isn't in itself really going to answer the question, right? 241 is, huge. My comment is you have to have an SBC, right? We said to you, you have to have an SBC. So do you see anything in the question that says council is an SBC, a small business corp, an SBC? Do you see that trigger there in the question? Yeah. So the answer is no. You can't. To be an SBC, you have to be a CCPC, but there's additional requirements, right, for SBC. So right now, based on the question, you don't know if council would meet those additional criteria. Does that make sense? Right. It's a good thought, and remember, of course, council, there's no loss. So, it's in a gain position, right? You have to be in a loss if in order to even consider able. Okay. Let's move on to the administration stuff. So, Simon 2-1, you're dealing with Gladys Knight. Let me just switch over to this question here in the textbook. Just give me 1 second. So you're dealing with Gladys Knight, and they give you 3 years of information. They tell you her taxes payable in 17, 18, and they tell you what her estimated tax bill is in 19. And you have 3 cases where you have to answer the question. So again, and for each case they want you to confirm whether or not installments are required for the 2019 taxation year, show all the calcs, what amount it would be required under the approach used in the CRA installment reminder. And then it asks, indicate if there's a better approach. Okay. So that's in part 1 or part A. Part B is to say, what are the dates? Okay. So you might remember our comment was 3,000 is the threshold. Your current year has to be over 3. So right, your net tax owing has to be above 3. Okay, and you have to have more than 3,000 in one of the 2 preceding years. So either 17 or 18, you have to have over 3,000. Okay, and again, in the 3 cases, they've told you the installments that have been withheld. Okay, so let's just go through this. So for each one, in each case, what you need to do is first say, oh, here's the tax payable based on what was given. Now we have to apply the payroll withholdings. Okay. And then you say to yourself, what is the net tax owing each year? Okay. And now you need to make your determination. Are installments required? So if you look at case 1, current year is over 3,000. Yes. Or one of the other 2 taxation years, one of the 2 preceding taxation years, is their net tax owing amount over 3,000? So in case 1, 2017 is over 3,000. So you would say yes. In case 2, again, do you have amounts over 3,000? So 2019, yes. One of the 2 preceding tax years over 3,000. Again, 2018, yes. So installments are required. In case 3, yes, your preceding tax years are over 3,000, but your expected current tax payable does not suggest that you are over 3,000. And so the answer is no, you wouldn't expect to be over 3,000. Like, sorry, you wouldn't expect to have installments. But it's really important to note this number, the 21,760, that's an estimate. Okay? Let's just say your estimate is wrong. Let's say, for example, you don't do installments because you sit there and say, guys, oh, you know, I think my current tax is only going to be 21,760. I've already done 19,440. I don't think installments are required. Now, let's say in reality, it's determined later on, oh, shoot, your real tax bill was 23,000. And your actual net tax owing was over 3,000. Then at this point, the CRA would ding you, and they would actually hit you with installment interest because you actually met the criteria where installments were required. So that's one of the issues with the current year when you're dealing with an estimate. You have to be certain that your estimate is correct. Otherwise, you are at risk where you could have installment interest applying. Does that make sense? Okay. So typically in real life, if you're kind of close, you know, for some people, this might be close. If you're close and you don't want to have any risk of installment interest applying, you go and pay, you just make your installment payments anyways. Okay. So just depends on your tolerance level. Okay, so now we go look at under the various methods. Again, if we look at CRA says, well, we always do, you know, our notice is always going to be based on combo method, right? The combination method. And remember, combination method is, right, take your 2017 payment, right? Take your 2017 payment, your net tax owing, divide that by 4. Okay? So in this case, in fact 1, it was 4,400. Okay? So we're going to take 4,400, divide that by 4, and you're going to use that for the first 2 payments in the year. Okay? So you do your first 2 payments. That means you're now at 2,200. Right? And then remember that the methodology says then you take your last 2, for your last 2 payments, take your net tax owing in the preceding year, less what you've already paid, take that number, divide that by 2, and apply that for the remainder of the year. Now, in this case, because your net tax owing in the preceding year was low, you've already exceeded that amount in the first 2 payments in the year. So in that type of situation, of course, the CRA is not going to give money back. Okay. Once it gets money in terms of an installment, it's not giving it back until you file your return. Okay. So in this case, the CRA would just say, okay, because your preceding tax year is already lower than the first 2 payments you've made, you don't need to make any more installments. Okay. So that's kind of how the combo method would look. If you use the preceding method, you just would have divide by 4, your 600 divided by 4, and that's all you'd pay. Okay. And in this case, again, this would be the best method because it's the least amount of cash flow. Okay. So even though you'd say, Chris, well, do you really have to pay installments because it's so low? The answer is you do because the criteria is met. But remember, preceding tax method is always a method that's available to you. And again, CRA doesn't use that as part of its notices because the general presumption is they don't know what your final tax bill is until after June 15th. Okay. So anyways, there is preceding, and of course current, just take your current taxes, divide by 4. And again, this method, if at the end of the day, right, this method is just an estimate. So this may be, again, CRA will always look back. So they'll always sit there and say, if you did current method and your actual tax bill was higher, then you should have paid more under the current method, in the past. So it's kind of a, current method is kind of a, not the greatest method in many cases. Anyways, does this make sense? Case one. Okay. Cheese, yes. Sarah's, yes. Anyone else? Everyone else good? Okay. Case two. So in this case, if you take a look at it, you actually had a refund in 17, and then you had tax owing in 18. Okay. So when you're looking at the combination method, again, CRA is not interested in giving you money back. Okay. So you take 2017 divided by 2. Well, guess what? You're negative. Now, CRA is not going to give money back. You're going to be zero for the first 2 payments in the year. Again, combo method, take what you owed in the preceding year, in 2018, back out what you've already paid in the beginning of the first 2 payments in the year, which is, of course, 0, which is nothing. So this would be 5440 divided by 2. Okay. Preceding method, of course, takes last year net tax owing divided by 4. Current method takes current taxes divided by 4. Okay. So obviously, this is right now the least amount of cash flow, right? There's your 3,200 estimate. Okay. So that's the best. However, let's say your estimate was wrong, and in reality, you owed more than 3,200. Say you owed 4,000. Well, at that point, CRA would say, "Oh, you filed your tax return. You actually owed $4,000, not 3,200. Oh, you know what? We're going to ding you installment interest because you paid insufficient installments, because you should have based your current method calc on the $4,000." So again, if your estimates are off and you use current method and your other methods are higher installment requirements, then the CRA will ding you for insufficient installments. Okay? Because CRA will say you should have actually installed higher. You didn't install a sufficient amount. Of course, because the preceding methods require 5,440, they'll never ding you for the difference in excess of the 5,440. Okay, this is like your ceiling in terms of the installments that you were required. So let's say your actual taxes owing was like 6,000. They won't take 6,000 less 3,200, and that's the amount that they're going to ding you installment interest on. They're going to take 5,440 less than 3,200, and that's what they'll ding you on. Okay, does that make sense? Okay, so that's 2-1. And for dates, again, for individuals, it's March, June, September 15th. Okay, and December 30th. Let me just resize this for a second. Just give me 1 second here. Yeah. Oh, and oops, sorry. Why does it say 31st? That's dumb. Sorry, this should be my bad. I don't know why I had 31st in here. Sure, sorry for that. That should be 15th for all of them. So just make sure you guys pick that up. You guys saw that, right? December 15th. Sorry, I had that one typo there. Okay. Anyways, I'm going to move on. So hopefully you pick that up. All right. Corporate installments, interest and penalties. This was 2-2. So you have here Leduc Inc. They have 3 alternatives. So they tell you that Leduc has a January 31st year end, and Leduc is a publicly traded Canadian company. So by telling you this, you now know for sure there's no, CCPC exception where you do quarterly installments, right? Typically, corporation is monthly installments. So this fact tells you that it is monthly. Okay. They tell you that for 17 they had tax payable of 193,420, 215,567 was a tax payable in 18, and they tell you they estimate it's going to be 203,345 in 19. Okay, and then they want you to, again, to calculate what are the installment payments that are required and indicate which alternatives would be preferable. Okay, so if we go through with this, right, again, current year, take your current tax, divide by 12, right, and number 2, then you take your preceding year amount. So this is 2018. Take that, divide by 12. Okay, and then the third method, again, for the first 2 payments in the year, take your 2017 amount, divide that by 12. For the remainder of the year, take your preceding year amount less the amount you paid in the first 2 payments in the year, divide that by 10. Okay, so divide that by 10, and that's the remainder of the year. Okay, so again, you always end up paying the same amount in the combo or preceding, but your payments are different. Based on that, you would say, again, current method has the least amount of cash flow, so that would be the best method to use in this case. But again, it's only an estimate. Your current year amount is always just an estimate. And so a company may say, you know what, we're not 100% sure about our estimate, especially in this case where there's only a small difference between the preceding year method and your current year method. They may say, you know what, let's just pay installments based on preceding or combination method. Probably in this case, combination. Okay. They might say, let's just do it that way, because if we do it that way, we guarantee there's no installment interest and there's very little difference between the two. It's very close. Okay. So if there's doubt, someone might say, especially in this case where the difference is small, let's go and use the combo method instead, combination method. Okay. But in this case, anyways, in terms of just pure numbers, the current method is the best. Okay. Any questions on that one? Why would they? Because your first 2 payments in the year are the smallest, right? So time value of money, you're better off doing combination method. Right? Time value of money, combination's better. So Part B says, what happens if you choose not to pay the installments? Okay. And did not file its corporate tax return or pay its tax payable on time. Then they say, well, can we talk about the penalties that would apply in each case? Okay. So number one, you didn't pay installments. So now you're going to have installment interest applying. Okay. And what they'll say is, because you're dealing with, right? So they're going to sit there and say, well, we're going to just ding you installment interest all the way to the balance due date. Okay. Now, in this solution, in this particular solution, what is being indicated here is that the balance due date is March 31st. Okay. So my question to you is that correct? Does that look right? Like, is the balance due date the March 31st for Ladue? Based on what was taught last class. Oops. Like, what type of company? I'm not seeing anything in chat right now. So does anyone know what is the due date for balance due date for corporations? When do you have to pay your final amount of tax? So if you're a non-CCPC, remember, if you're a non-CCPC, it is 2 months, which would then be, so if you take a look at Ladue, right? Ladue's year end is January 31st, so 2 month is March. If you're a CCPC though, how much time do you have? So let's say Ladue was not a public corp. Ladue was a CCPC. How much time do they have? Yeah, they have 3, right? So if this was CCPC, your balance due date would be April, right? Again, it's a January 31 year end, not December 31st. This is not a calendar year end. This is January 31st year end. So 3 months, February, March, April. That would be if it was CCPC. Okay, so just keep that in mind. In this question, it's Pubco, so it is March, right? Again, 2 months from the January 31st year end is February, March. Okay, so your interest would be prescribed rate plus 4%, and that's what will be charged on your 203-345. And they would just, right? So, but you have to remember, again, interest would be liable from the date of each installment up to March 31st. So there's going to be an individual calculation done for each installment payment that was missed. Okay. Also, there would be penalties. and it would be 50% of the amount by which the interest owing on the late deficient installments exceed the greater of 1,025%. Okay, or 25% of interest that would be owing if no installments were made. So this is just a formulaic calculation. We didn't want you, we didn't ask you to calculate these. And likely in the exam, you're just going to need to memorize this. We're not likely going to ask you to do all the detailed calculations that you would need to do on penalties, because again, like, you would really need a template in order to do that. So in the exam, if we were ever in a situation where we may ask, likely I would give you a template ahead of time to use. Okay. In terms of on the balance due date, now if Ladue continues to not have paid taxes, now they're going to subject you to interest on the entire balance owing using a rate of prescribed rate plus 4. So for every day after March 31st that you have not paid your balance due date, now you're going to have interest being applied on the prescribed rate plus 4%. And then if you don't file your tax return on time, right? So again, what's your due date for your tax return? It's normally 6 months. So again, on a January 31 year end, 6 months is going to be July 31st. You're going to have a 5% penalty plus 1% per month of the unpaid tax for a maximum period of 12 months. And that's on top of the fact that you're going to have to pay interest, okay? Plus, interest is charged on the penalties such time as the return is filed or the installments are paid, okay? And then if you do a second offense, the penalty can be doubled to 10% plus 2% per month for a maximum of 20 months if you have 2 offenses within a 3-year period. So basically, the interest and the penalties can really snowball if you do not pay the amount that you owe to the CRA. Okay, so the key thing to note as well is if you have, let's say for some reason in real life, you paid the sufficient amount of installments, and let's just say you paid your balance due date on time, and now, but you didn't file your tax return, okay? Because these penalties are based on unpaid amount of tax, if you paid all your installments and you paid your balance due date, you're never going to have to worry about an actual penalty being applied, okay? On top of that, you don't really have any interest to worry about if you paid sufficient installments and you paid your balance due if you didn't file your return, okay? So the key thing is, in the worst case scenario, say for whatever reason you're not going to be able to finish your return on time, at the very least, make all your payments, then you won't have any issues around interest or penalties. The only issue with not filing your return on time, though, even if you paid all your balances due owing in the year, the problem is by not filing on time, the next time you mess up, if you mess up again within that 3-year period, your late filing penalties will be doubled. So even though you paid everything on time, right, the first time, if you screw up the second time and you didn't pay things on time, and you couldn't file, now you're going to have double the penalties. Okay, does that make sense? Any questions there? Yeah. So Durzak, Harrelson says they're okay. Anyone else? Okay, GST. Let's just go to EP 21.1 here. Oh, wait, I have to open up the other text. Sorry, give me 1 second. I just want to. Oh, that's right. They didn't send it to us. Okay, never mind. They didn't send me the digital copy for that. Anyways, for AP 21-1, basically it was a scenario where they wanted you to look at GST and look at as well look at things from a PST perspective, like what they called it turnover tax method. Okay, so they said, given some numbers, what is the total amount of GST that's remitted to the federal government if you go through all the different levels? Okay, so if you go through all the different numbers, right, cost for the manufacturer is $250, right? So raw material supplier sells some material to manufacturer. Manufacturer pays $250. Okay, they're going to be charged $12.50 of GST. Okay, at 5%. So now raw manufacturer says, okay, I paid $12.50 GST. I'm going to claim what we call an input tax credit. I'm going to claim a refund, right? A recovery of the $12.50 that I paid. But I sold the same, I added some value, and now I can sell this product for $3.50. So at $3.50, I'm going to charge $17.50 of GST. So the net amount in this case, if you look at the net, the manufacturer net is going to pay to the government $5 of GST. Okay, because net he's going to get a refund of the $12.50. He gets an ITC, and he's going to get $17.50. Okay. No, sorry, he's going to remit $17.50. So again, the net is $5. The wholesaler, of course, they bought from the manufacturer for $3.50. So they're going to sit there and say, well, we paid $17.50 in GST. We're going to recover that amount. Okay. So now you go and you recover your GST, your $17.50, but now we're going to be able to mark this up and sell it for $4.90. So $4.90 times 5%, that's going to be $24.50. Okay. So again, because they're claiming the refund of the $17.50 they paid initially, they're only going to remit a net amount of $7 to the government. Okay. Now wholesaler sells to a distributor. Distributor says, okay, I'm going to pay $24.50 GST, but now I'm going to be able to mark this up to $6.86. So again, 5% of $6.86 is $34.30. Again, net amount is $9.80. Okay. Now you sit there and say to yourself, okay, retailer, I'm going to recover the $34.30. Now I'm going to sell to the general public for $9.60.40, and my GST charge is going to be $48. So now I'm going to net remit to the federal government $13.72 because I'm going to get a refund of the $34.30. So at the end of the day, the net amount of tax the federal government collects is only $48 because at each level, whatever GST they paid on purchase, all these businesses are going to be able to recover. Okay, so they can always recover the GST they paid upon the purchase, but they're going to remit the GST that they collect, that they had to collect from the customers, right? So the net difference is what they have to pay. If you take a look at a turnover tax, okay, they sat there and said, well, effectively, what is your tax rate if you were remitted only $48.02 total? And at the end of the day, it's just an algebra problem, right? So you just add up all the different, all your sales prices, and you say, well, that amount times some rate must equal to the 4802. So if you just do your simple algebra, you'll say, oh, I find out, you know what? The equivalent rate in a turnover tax situation is only 1.755%. Okay. So in a turnover tax situation, like PST, where each transaction, the tax is charged and collected from and then remitted to the government, you're going to ultimately pay more taxes overall. Okay. Because remember, GST, this is like using a VAT tax, a value added tax like GST, where only the incremental tax is charged at each level. At 5%, you're only collecting 4802. On a turnover tax, you're gonna, it's much lower because there's no refund at each level. Okay, but in real life, governments might say, we're going to charge a 7% tax, right? In BC, it's 7% tax. Well, on a turnover tax, you're going to pay a lot more in tax. Like if PST was 5%, right? Remember, if PST was 5%, there is no ITCs. Okay, there's no ITCs. So in a turnover tax at 5%, you're remitting $136.82 to the government. Okay, whereas with a GIA value added tax, the government's only getting 4802. And remember, in our example before, at each level, if this tax becomes a cost at each level, and every level wants the desired markup that they want, everyone pays more at the end of the day. And it's the end consumer that ends up paying the most. Okay, so turnover tax is generally considered a very costly tax. It's also considered a hidden tax because you, the consumer, cannot see the tax that's being paid at each level. Okay, does that make sense? Should expand on this one. Okay. Also, I will say on a personal note, the PST is one of the most annoying taxes ever because the way it is written is absolutely terrible. It is not a well-written tax. So interpreting PST legislation is, in my mind, more difficult in many cases than the federal legislation. So that's one of the other kind of hidden costs of rejecting the HST and reinstituting the PST, because by doing so, you not only basically increase the cost to everyone, what you've also done is instituted a more difficult tax to interpret. And there's a cost to that that's not very well quantifiable. Okay. I mean, it does lead to more tax jobs, I have to admit. So maybe in that sense, it's not the worst thing in the world, but really from a business perspective, it's not very good. Okay. Let's go through 810. So 810, this is again, this was the key thing whenever you have partial change in uses. Okay. The key thing is you always need to track your tax attributes each year. And you have to remember, at the end of the day, no matter how the floor space, in terms of the physical location in the building, in terms of what is non-income producing or non-income producing, regardless of that, the government always views you as having two properties within the building, the non-income producing property and the income producing property. So again, when you're doing this, you need to keep this in mind. Okay. So you have Miss Coos. She's purchased a building. And again, this is 8 assigned problem 810. I want to leave the best one for last. Okay. So you have Miss Koo. She purchased a building and she wanted to use it as her principal residence. Okay. And She spent 360, and they tell you 90,000 is land, 270 is building. Okay, so 100% of this building non-income producing purpose. After living in this building for 2 years, Jan 1, 2017, she converts a portion of this building into an office, and she rented it to a local accountant for $1,200 per month. At the time of the conversion, fair market value of the building was 360. Okay, so the building has increased, the land is unchanged. So now it's 360 and 90,000. Okay, so now she says, and she says it was 30% of the space that was converted. Okay, Jan 1, 2019, the office was rented by a new tenant who did not require the same floor space as the previous tenant. As a result, they converted one room back to non-income producing purpose, so to personal use. So that room was 10% of floor space. So 10% effectively changed in use from income producing to non-income producing. And they said that at that time, fair market value of the building increased to 420. The land did not change. Okay. And then they've asked, what is the maximum CCA deducted in 17, 18, and 19? And they want you to know if there's any capital gains or losses from the change in use. Okay. So just they make life easier for you guys. They did not change the value of the land. In real life, that's not going to happen. That land is going to change in value. It doesn't stay. But to make your life easier, they kept the land value constant. Okay. So if we go through the problem, so you know you have a change in use in 17, 18, there's no change in use. Okay. But remember, they said they want to deduct maximum CCA each year. So even though there was no change in use, you have to remember you need to calculate CCA. Okay. And that's going to affect your conclusions in 19. So you need to do that. So again, identify all your disposals. Okay, well, we've got two disposals in 17 and 19 from change in use. Okay. Now, is there any special property? Well, yeah, we do have principal residence being sold. Okay, well, we need to think about that. So let's go through this. 2017, we have a change in use. So you sit there and say, okay, what is the ACB of the portion that's changing in use? Okay, well, it's 30%. So 270, right? Remember, that's the original cost of the building. 270, 30%, 81,000. Okay. 108, what's the proceeds? All right, well, proceeds is, remember, when you have a change in use, the taxpayer that held the property before the change in use is deemed to dispose at fair value. Okay, so Ms. Coos is the person that held the property before the triggering event, before the change in use. She's deemed to dispose. Well, what does she sell for? Well, fair market value is now 360. Right? 360 is my fair value. Well, 30% of 360 is 108. Okay. So cost base we calculated above here is 81. So the difference is 27,000, 50%. You're going to have a 13.5 capital gain. Now, in this problem, they haven't told you that there's another principal residence out there. Okay. So right now, the only thing we know is this is the only property that Miss Coos had that is her principal residence. So now you sit there and say, well, yes, you have this taxable capital gain, but basically she could file a principal residence election or exemption, principal residence exemption claim, and she can exempt this 13.5 gain. Okay. Okay. So this is the capital gain, but you file your exemption claim, your principal residence exemption claim, you'll exempt this. Okay. Now you sit there and say, in a change in use event, again, who's the taxpayer that held the property after the change in use? And in this case, again, it's Ms. Coos. So now she's deemed to acquire at fair market value for purposes of calculating the capital gain. Okay, but for UCC, remember what I said before, when it comes to UCC, you do not get the full fair market value, that full gain does not go into UCC because it's unfair. The capital gain would only be taxed at 50%. CCA, whatever you put into CCA, you can deduct at 100%. So the government, we talked about that rule, the amount you can add for UCC purposes is going to be cost plus the taxable portion of the capital gain. Okay, so the government said you can't do 27, you got to do cost plus the taxable portion, which is 13.5. So the cost that you can put into UCC is only 94.5. So that means that when you do your CCA calculation in 2017, you're going to have, and remember, you are not dealing, remember, AII regime only applies if your additions were made November 21st of 2018 and beyond. Okay, so remember, we are right now in 2017. AII regime does not yet exist. Okay, does not yet exist. So you would put 94.5 into UCC, and you would apply half year rule. So if you did that, and remember, you have a principal residence in this building, right? So this is not, you cannot say this is a non-residential building. So therefore, you must be at 4%. Does that make sense? You must be at 4%. And so then you claim 1890 in CCA. Okay? Does this first part make sense to you guys? Because this is key, right? This is the whole point. Like, if you don't get this part, you're going to be totally confused on change in use. Well, there's that. Remember, the land did not change in value. Right? The land did not change in value if there's that. So is there a gain? Could there be a gain? Right? Land always stayed at the value. They kept the land value at $90,000. So your proceeds, ACB, will always be the same. So there's no gain on land. Does that make sense? Yeah. So, I mean, technically, is there a disposal? Yes. On the land, there is a disposal. But because land value never changed in this question, there's no gain or loss. So effectively, they're basically telling you to ignore it. But yes, there would be a deemed disposal on the land, but there's just no gain or loss on it. Okay, Goosen, are you okay? Is that enough, or do you need me to scroll up more? Okay. Does anyone else have questions? Does it make sense to the rest of the group? Because I only see like maybe a group of like 7, 8 people that are regularly saying yes or no. So it makes me wonder if anyone else is sleeping. Yes, it's 4%. Because remember, Harrelson, it's a principal residence in that building. You can't say this is non-residential. Yeah. What happens if land increase? Okay, so let's just say, okay, I'm just going to do this on the side here. So let's pretend, I'm just going to put a comment here. Pretend land increased to fair market value increased to 135,000. Okay. So you would sit there and say, what's your proceeds? Okay, so proceeds. So remember, even though on land, you would say, Chris, the whole building sits on land. Okay, we would sit there and say, let's pretend that you'd have to subdivide the land as well. You have to say 30% of the land changed in use because 30% of the building changed in use. Okay, that's kind of how they would do it. So you would say, what's 30% of the new fair value? Okay, so fair value is 135. 30% is 45. What's your ACB? Well, what's your original cost? Right? The original cost of your land was $90,000. Okay? Okay, so 90,000 times 30%. And you just do your calculation of a capital gain. So, right? And then you'd say inclusion factor is 50%. So your taxable capital gain is 6,750. Taxable capital. Okay. Let me just unwrap this text. Okay. So at the end of the day, you'd have a taxable capital gain, but again, it's the same thing. You can exempt this gain as well with the principal residence exemption. Does that make sense, Seema? So you would just show a simple capital gain calculation for that 30% of land that changed in use. Okay. Right. I'm going to delete this though, because obviously the rest of the question, the land did not change in value. Okay. So I'm going to delete this. 5, 4, 3, 2, 1. Okay. Done. Okay. Okay. 2018. I'm going to move on now. 2018. Again, nothing happened, but you do need to just continue to calculate your CCA. Okay, because again, you were told calculate the maximum CCA per year. You can't tell me, you can't say, Chris, I choose not to claim CCA. Well, no, you were told in the question you had to claim maximum. So if you just claim your CCA 4%, you're down to 3,704. Okay. 2019 tax consequences. So 10% of your floor space is now changing in use again, and it's going from income to non-income producing. So you have to remember, at this point in time, right, you have a building. I'm just going to diagram it here, right? Like, let's just pretend this is your building. Let's just pretend this block is your building, right? 1, 2, 3, 4, 5, 6, 7. So 3, 6, 9. Okay. So pretend this is my building. Okay. This is my building. Okay. This portion, I'm going to use a color. I'm going to color code it. This portion, these 3 blocks, this portion is my income producing. Okay. This is my non-income producing. Okay. So we're going to call this non-income producing. Okay. So now they're telling you, hey, 10% of the building. So let's just say it's this piece here. So we're gonna put this in thick border. This portion, 10% change in use. Okay, so 10% of the building is going through a change in use. But the key thing you have to ask yourself is, what proportion, remember, these are considered 2 different properties now, right? Your income producing, your non-income producing. These are being viewed as two different properties. So when they say 10% of the building is changing in use, the question you have to ask yourself is, what portion of the income producing property is changing in use? So when you do that, well, this is 30% of the building, 10% is changing in use. That means 1/3 of your income producing property is changing in use. So if my ACB, right, remember we calculate our tax attributes at the end. For my income producing portion, the ACB is 108. So the 108, right, 1/3 of that is 36. So the ACB for that 10% portion that's changing in use is 36. They tell you that the fair value of the building increased to 420. So 10% of 420 is 42. You're going to end up with a capital gain of 6,000, taxable capital gain of 3,000. Okay? Does that make sense? Because this is considered a tricky part. Like a lot of people could screw this part up. It's 1/3 of the income producing property that is changing in use. Okay. So June says okay. How about everyone else? Does that make sense? So everyone's saying good. Yeah, because again, 10% of the building, right? The building is worth 420. 10% of the building is 42, right? Harrison? It's tricky because you kind of have to go back. You're kind of switching between your different views, right? Because sometimes you got to look at just the income producing portion, but then you got to then recalibrate. Like again, fair value is based on the whole building, right? So then now you're going to do 10%. But here because you're looking at just the income producing piece, you're looking at 1/3. So kind of switching of views for some people can be difficult, but you kind of have to be able to do that. Did people make a mistake at this step here when they're calculating the ACB? Did people get thrown off track here? Because this is the whole point of where I was hoping the handout can help you out a little bit. So Hui got thrown off there, but you're good, Hui, right? Like it makes sense to you, right? How we're doing it here then. Okay. Okay, so that's the capital gain part. Now here's UCC. So you have to remember, for UCC, you did not put 108 into UCC, right? When we go back here, right? Remember, you could only, in the beginning, we could only have put in cost plus the taxable portion of the gain. Okay? Back in the past, when we went from non-income producing to income producing, the amount we could add to UCC was only cost plus the taxable portion of the capital gain. So knowing that, and knowing that we establish 1/3 of the building is being 1/3 of the income producing piece is being disposed of, 1/3 of 94.5, the cost for UCC purposes is 31.5. So we have to remember, proceeds was 42, right? So when you do what is your lower of cost and proceeds, it's the lower of 42,000 proceeds, 31.5 cost. So of course cost is lower, so you're going to show 31.5 as a disposal in the year. So you show the disposal, you still have an income producing property, you are not negative, so there's no recapture, and because again you still have the property, there's no terminal loss, so therefore you just calculate your CCA. Does that make sense? And again, you don't worry about land because there's no change in fair value in the land. Okay, so hopefully, partial change in uses are not too difficult for you guys now. Now that we've gone through this, you have to be. It's a little bit of a, it's a bit detailed, but you do have to. The key really is you just need to keep track of all your tax attributes. After every change in use, you really should make sure you calculate what is your new ACB for that portion, for that new portion. Okay, and arguably you can even argue, really, I should have shown the ACB for the non-income producing portion, the portion that didn't change in use. Okay, you could even say that should be done. But regardless, the key thing is you have to have a process to track your attributes as you go on every year. And then I find, for me, diagramming, right, like just doing a simple diagram like this can help me picture what's going on. So again, for some of you guys, this might be helpful. And again, this is very simple to do in Excel, right? It's just literally just creating boxes and changing colors. Okay, so if you ever wanted tips, I mean, to me, these are the tips that are out there to help you with this type of problem. Okay, well, it is right now 10:15. What I'm going to propose is we take a 15-minute break. I had originally wanted to record this part, the lecture piece for this week. That's what I wanted to do, but unfortunately for me, work was very busy, and I got. I had to basically. I've been asked to take over my boss's role when since he retired, so I kind of had a little bit more work than I anticipated. And so I just didn't get the chance to record it. So we'll just go through the lecture after the break as normal. And I would suggest make sure you have some coffee, because it's there's going to be a lot of detail flying at you in terms of the next at least hour, 2 hours. So let's reconvene at 10:30. Make sure you get your coffee. Okay. Um, Before we start today's lecture, I just wanted to bring you up on some current events that's pretty significant from a tax point of view. Um, there's always been this question, especially right now, right in a Corona environment. I don't know how many of you guys have like used like a Uber Eats or a Skip the Dishes or a DoorDash to order, or I know there are also like Asian. I know of Asian companies that do kind of a similar thing. But uses and has any of you actually been like a driver, like part time, like been like I call it a gig worker to to earn some side income? Has any of you actually been like a driver for one of these services, like an Uber driver or Uber? You did Uber in the U.S., like a taxi app. Anyone else? No one else. So one of the things that's always been a big question is, are you an employee when you sign up for an Uber or for a DoorDash? And for companies like Uber and DoorDash and Skip the Dishes, they absolutely do not want to treat you as an employee. Because if they have to treat you as an employee, it's a huge issue. The cost, the payroll withholding, the administrative burden would make it much higher. Plus, on top of that, they don't want to be involved in any way, shape, or form in terms of having to create employment standards and adhering to employment standards. They really don't want to go there. But it's always been a key question, are you actually an employee? Because if you are, they have to guarantee that you make at least minimum wage, right? On top of all the other stuff. And for tax, of course, the question is there payroll withholdings that need to be done? Is there CPP? Is there EI? As a driver, are you allowed to deduct your expenses, etc., right? Like what expenses can you deduct? If you're an employee, you're going to have fewer expenses that you can deduct, right? So this goes all the way back to the employee versus independent contractor. And the biggest thing for people was who has control. And a lot of it is, an argument is, well, Uber determines, we have to deal with Uber or we have to deal with Skip the Dishes. We have to, they are the ones setting the amount that you get paid, right? Etc. So there's been a question, especially around control. Who has control? And in this lawsuit, this was huge because now, if this class action lawsuit succeeds, Uber, Skip the Dishes, all these the gig economy that people like to call it, if this lawsuit wins, you have to treat them all as employees. And that would really change how these services have to operate. Okay. So this is something that at one point in time, I thought about doing a side project on. Of course, this ruling came in late, but because of this ruling, I might actually create this project in for next class. But anyways, this was really this is really an interesting court case, one that's definitely worth keeping an eye on because it does have, I would say, a fairly profound impact on how these services would go going forward. Anyways, that was just something I thought was pretty cool. Okay, we're now going to go into business income. Can you believe it? This is the last lecture in which I'll be teaching you new material. After this, there's nothing new. It's like the last time you'll hear me teach you stuff. Probably a relief for you guys. Anyway, let me just close this window. There we go. Control in terms of what? Well, just control in terms of work. Right? Who controls the work? What you do, how you do it, who has control? Right? That's a whole debate. I would tell you now it's very gray. Anyways, to answer your question, Hui. Um, okay, so in terms of week 10, um, we're going to start off by looking at the PowerPoints, but for the most part, we are going to move away from the PowerPoints and going straight into the example. We're really going to be teaching off the example the example handout that was in the week 10 contents. Okay, but we'll start off with the PowerPoint. And the PowerPoint really is more of a reference slide. So we're now into chapter 6. Okay, chapter 6 is considered a fairly important part of the course. So chapter 6, there are 5. Of course, we're dealing with business income. So the main rule around business income is 9(1) of your act. So what I would ask people to do is turn to 9(1) of your act, and what I want you to tell me is, how clear do you think this rule is? So, and then for chat, what I would say to you is, when you read that, how I would just want you to comment, do you think this is very broad? Is this a very flexible provision? So if you go to page 43 of 9.1, it's very short. Do you tell me, how clear is this rule? Like, how do we determine income? How do you determine your income? Does this provision help you figure out how you determine your income? Anyone? If you turn to the act, how helpful is this provision? Is this fairly easy to understand or fairly easy to apply? Too general. So here's a question. What type of gap do you guys learn in your classes? What standards do you guys learn? So you learn IFRS, you learn ASPE. So here's my question. Could you use either? Are the rules the same between your accounting standards? Like, are they the same, Harrison? Is IFRS ASPE the same? Are they different? No. Because the rule just says profit, right? It's just very broad. Let me ask you this. What's to stop me from China GAAP? Which is basically whatever I want it to be. If I roll it on a napkin, my profit's $1. Is that wrong? Like, if I just look at this rule in isolation, is there anything that really says that defines? Like, this rule does not define anything. If you look at the notes to section 9, it's super long because of the vagueness of it all. The key thing about section 9 is you can use whatever method you want to calculate profit in the year. Okay? And this was determined in the Canderel case, which is considered a landmark case. But there's one caveat. The caveat is it must be a reasonable picture of your income, and 2, it must not contradict any other section of the Act. So in other words, you cannot violate any other rules in the Income Tax Act. But as long as you're not doing that, you can calculate profit however you want. So why is it that subdivision B has so many more rules than subdivision A? Because there's so much flexibility in how you calculate income, the government has to put a lot of rules in place around all the various expenses and whatnot and income that you can recognize. Okay, so the big thing is here is if you take a look at the listing of these rules, 9 bracket 2, you know, so there's 9 bracket 2, there's 9 bracket 3. Basically, what these rules are trying to say is whatever rules that are applicable in this subdivision, you don't just arbitrarily apply them to other types of income or other subdivisions of the Act. Okay, so in other words, what they're trying to say is, for example, when you determine your under 9 bracket 2, your loss for the year, okay, you're only supposed to look at the business source, like at this subdivision. They don't want you to kind of go and start looking at other subdivisions. And subdivision 3 basically tells you don't include capital gain or loss here. This is just business or property losses in subdivision B. Okay, so they basically are trying to make it so that you look at subdivision B in isolation. Okay, 12.1, we're going to talk about various provisions, but you just need to be mindful. 12 bracket 1 in general, okay, deals with income inclusions. 18 bracket 1, which again, there's going to be various paragraphs that we're going to look at in 18 bracket 1. 18 bracket 1 is basically is the provision around what are allowable deductions. Okay, or deductions that are not allowed. Okay, so the 18 bracket 1, and we'll talk more about this in detail later on. 18 bracket 1 can mean a number of things, but effectively it's around deductions. Section 20 for sure is around allowable deductions. Okay, 18 bracket 1, sometimes it's more about preventing deductions, but also sometimes it's about allowing deductions. So 18 bracket 1 kind of can go both ways. Section 20 is purely just what are allowable deductions. Okay, and then section 67, again, it's another key area, and we'll talk about some of these, is about what is considered reasonable for an expense. Okay, what amount is considered reasonable for an expense? So we're going to kind of delve into all these different areas of the Act. Okay, so at this point in time, what I want you guys to do is open up the example handout. So if you go in this Word document, right, income from loss or from business example, if you can just flip to that, and we're going to start going through this handout. Okay, so just give it a second there give you time to do that. Okay, so first off, the way the Act is structured, you guys are basically been taught when you're doing GAAP, GAAP is on an accrual basis, right? If you do IFRS, you do ASPE, all that is accrual accounting, right? So it's not on cash, it's on accrual basis. So government, first rule the government said was, well, what happens, how do you handle situations where you receive cash or whether you've earned income, right? Like, how do I deal with it? Because cash is one thing, accrual basis, did you earn it, is another thing. So the government said, when it comes to just accounts receivable in general, where you are crediting revenue, debiting AR right in your accounting books, where you've earned that income, 12.1b says, we want you to recognize that, okay? Then the question becomes, well, what happens if you have a situation where you are paid in advance? Okay, so I don't know if you guys, what do you call this in accounting? You've been paid in advance for something, for a service or good that you will provide in the future. What do you what do you call that, or how do you treat that from an accounting point of view? Yeah, unearned or deferred revenue, right? That's typically what you do, right? You record the liability because you have not yet actually earned this income. Well, the question is, well, what do you do for tax? Okay, so if you take a look at our example, point number one, you have M's sales. Does not include a payment of 1.25 million received from one of their large customers, and it's a prepayment for a shipment that will be delivered in 2020, January 2020. So in that case, what does tax say you do? So what you need to do, and now I'm going to refer a lot to the act in your textbook. Oh, sorry. I'm going to refer a lot to your act in this situation. So if we go to 21M, so actually there's a couple of things. Number one, you should go to 12.1A of your act. Okay, so 12.1A is on page 53. Okay, so I'm just going to call out the pages. People can tab them as they wish, but we're not going to spend too much time waiting for people to get to those pages because we're going to go through quite a few. 12.1A on page 53, that says where you have been paid cash in advance of delivering a good or service. So deferred revenue, you must recognize that amount into income. So in other words, you get the cash, put it into your income. Doesn't matter if you earned it or not, okay? But what the government says is, but if you didn't earn the sale, you could claim a reserve. Okay, so the reserve provision is called 20(1) bracket M. So, and that is on page 152. This one I'm going to wait for you guys to get to in your act. So just type in the chat when you get to page 152. Okay, Sarah says she's there. So 21M, what it says is you can claim a reserve if you have not yet earned the sale. And the key thing here is you have flexibility in terms of the amount of the reserve. So for example, in this situation, 1.25 million of deferred revenue, what the act says is you can claim a reserve anywhere between 0 and 1.25 million. Okay? You don't automatically say my reserve is 1.25 million. You can choose some amount in between. Now, why do you think that's the case? Why is it that the government is letting you claim an amount, like a discretionary amount? Why not just say your reserve is 1.25 million? Why do this whole, recognize the 1.25 million and now claim a reserve of up to 1.25 million? Why not just say it's 0 in the first place? Why this convoluted mechanic? Why the choice? Why do you think there's a choice? No, it's not about being conservative. That's for sure. It's not about conservative. What did we teach you guys in week 1 about losses? Who remembers? Right, non-capital losses. You can carry them back 3 years. You carry forward how many years? Who remembers? 20. Yeah. So imagine those have expiry dates, right? So say, for example, your losses are expiring and you need income. Well, one way to get income is to just recognize that advance, right, under 1.25 million into income, and then maybe claiming a smaller reserve, right, based on whatever losses you're trying to utilize. Okay, so the government basically created the mechanic the way it is because they wanted to give taxpayers the option to generate some income and utilize losses that might be expiring. Okay, so in the example handout, under 21M, we're presuming there are no losses that we need to utilize, so we're claiming the full reserve. Okay, and the thing is this: how do you deal? Like, so there's all this flexibility. So how is it that we're going to calculate income for tax purposes? Okay, so here's the thing I want to show you here. So we call this the Schedule 1 method. Okay, so we're going to go through this. We're going to talk about accounting. We're going to talk about tax. And the Schedule 1 method, basically, it's not really a method. Schedule 1 is basically a reconciliation. Okay. And by the way, does anyone, like, when we say reconciliation, what is it? Like, do people understand what we're really saying? And I ask this question because a lot of workplaces do a shitty job when it comes to making things clear in terms of reconciling. When you're reconciling, what are you trying to do? Balance? No, not quite. I wouldn't say balance. Accounting for the difference? Kind of. The key thing is what you're trying to do is look at two different numbers, typically from two different sources, and then you're trying to explain what the differences are. Okay? And sometimes companies will do something and they'll confuse what I would call a summary versus a reconciliation. Okay? So you just got to be careful. But at the end of the day, what you're really trying to do is reconcile two different numbers and then say, what is the difference between the two? So in the Schedule 1 of your, so we say Schedule 1 because that's the name of the schedule in the corporate tax return, okay, in the T2 corporate tax return file. Schedule 1 requires you to reconcile your accounting per your financials to your net income for tax purposes, okay, for a business. Okay, so you have to reconcile the two. And so you have to remember when you're coming up with, well, what's your reconciling item? What's your difference? Okay, what you're always asking yourself is, what is accounting doing versus what is tax doing? Okay, here, I should make this bigger so you can read this better. Okay, so what is accounting doing versus what is tax doing? So for example, for the 1.25 million, okay, accounting says 0 because I haven't earned the revenue. Tax says no, but you have to recognize the 1.25 million into income. So your starting point is, pursuant to 12.1a, oh, I got to recognize 1.25 million to income, right? And there's my starting point, 3.784. Now tax says you can claim a reserve of 1.25 million because the entire amount has not been earned. Okay, so now we sit there and say, okay, well, tax, accounting says zero. Accounting didn't have income in the first place, so it didn't recognize the reserve. Tax says you got to deduct 1.25. So again, to get to tax, right? If you start with accounting and you want to get to tax, you got to deduct 1.25 million. So that's your adjustment. Okay, so the direction of your comparison is dependent on the direction of your reconciliation. I'm going from financials to tax, right? I'm going from financials to tax, right? So again, accounting is here on the left, tax is on the right, because I'm going from accounting to tax. Okay, so what is the adjustment that I need to get to tax? In your homework, you're going to have to do the reverse. Okay, in one of the questions, you're being asked to go backwards. Okay, so as long as you understand the concept of reconciliation, you should be able to go backwards and forwards very easily. Okay, so just keep that in mind. But in this case, under the normal Schedule 1, you start off with your net income per financials, and you want to get to your net income for tax at the end. So you're trying to arrive at tax at the end of the day. So what adjustment do you need to do to your accounting numbers to get to tax, right? That's your normal Schedule 1. So in this case, that's going to net to zero. Okay. Does that make sense so far? Okay. I'm not seeing people throw questions, so presumably this is all fine. Number 2, M had a 3,500. And by the way, in your midterm, if we give a large question and we're going through all these provisions, how much are the provisions worth? The provisions are worth half the marks on your big Chapter 6 question. Okay, half the marks on the big Chapter 6 question. Anyway, so just so you know. So you need, for this chapter, you need to know. Is this like your journal entry? I hate saying it like that because the reality is, it's not like you're keeping a tax financial, like you're not doing a set of financial statements. So I hate using the word journal entry. It's not really, it's just adjustments. You're just showing the adjustments you're putting through your tax return to get to your tax number at the end of the year. So M's had a 3,500 life insurance policy on the life of the president. The company was a beneficiary. There's no banking or other requirement for the insurance. So what we're going to talk about next is probably the most important provision you're going to learn in this class. Okay, so that provision is 18.1a. So if you turn to 18.1a in your act, it is on page 112. Again, this one I want you guys to flip to. Oh, actually, sorry, I'm going too far ahead. I forgot. Before I go further, my apologies. Before we go further, let me just talk about 2 other reserves that we need to talk about before we go further. So number 1. And let me talk more about reserves in general. I'm forgetting a couple pieces. Number 1, when you have a reserve, if you claim reserve in general, so under any of these provisions, 21M, N, or L, when you claim a reserve, that reserve must be added back into income the following year. It's very similar to the capital gain reserves that you guys learned earlier. Okay, each of these reserves that I have on the screen, 21L, M, and M, they each have a separate rule that says you must add that reserve back into income. Okay, so for 21M, for example, we should flip back to 21M in your act. Okay, so if we go to 21M again, so 21M again was on page 1. So again, this is something that you guys might want to be mindful of when you're studying for the exam. If you go back to page 152, 21M, if someone can just quickly type in chat if they're when they're there, so I don't go too fast. And again, you may want to tab these pages. Okay. So where you go to 21M, the provision, if you go to page 153 now, and you'll see at the bottom, there's a related provision. So at the bottom of 21M, at the end of it, you'll see right above where they have the notes to the section, they have related provisions. Okay. So the rule that says you must include this reserve into income the following year is 12 bracket 1 bracket E bracket I. Okay, so the Act is telling you where to go for that provision that says take the reserve, put it back into income the following year. So in our example, right, we're talking about 2019, we're claiming a 1.25 million reserve. 2020, under 12 bracket 1 bracket E bracket I have to put the 1.25 million reserve into income. And in this case, because now I earned the sale in 2020, if I delivered it in 2020, then there's no new reserve to establish. There's no new reserve under 21M. So I'm ending up at a 1.25 million income inclusion. Okay, does that make sense? Any questions there? Don't see anything in the chat. Huh? So again, if we were to look at the situation, right? This is in 2019. Okay. In 2020, right? In 2020, right? You say there's my net income for financials. I would have to take this reserve, and it has to be added back into income again, pursuant to 12 bracket 1 bracket E bracket I. Right? So if I did this again, right? 0, negative blah. Okay, does that make sense? So for the following year, that reserve has to be added back into income. No, it's always following year, Marie. You can't carry back in this case. This is just, again, you have to add the reserve back, and then you determine whether you meet the criteria to claim a reserve again in the following year. It's just like capital gain reserve, right? Capital gain reserve, exactly the same thing. Okay, so you add the reserve back, then you determine what is the reserve you can deduct in the current year. Okay, so it's exactly the same. So you have to add it back. Okay, and that's under 12.1E bracket I for 2020. I'll put it in the same column so we're seeing. Okay. Now, in terms of reserves, 21L, the reserve for doubtful accounts. This is basically taxes bad debt reserve. Okay. Now, you guys learned allowance for doubtful accounts, right? AFDA in your accounting courses. Here's my question. How do you guys calculate AFDA? How do you guys still determine your AFDA? Uh, no. Like, I mean, be more specific. Like, are you looking at like in your courses? How do they teach you to calculate your AFDA? Like, how do you determine your bad debts? How do you determine the uncollectible percentage? So you can look at you can look at a couple of things, right? You can do it on a specific balance basis, right? So you can say, I'm going to look at my AR aging, and we're going to say, based on these, we review all these accounts, and based on our knowledge of these of our customers, we think these balances are going to be uncollectible. We typically call that, you're looking at specific, you're doing it on a specific basis, specific account balance basis. You can do a general provision, right? So some companies, what they say is, well, on average, about 3% of our sales or 10% of our AR is uncollectible. So you can do what we like to call a general provision, where you don't really look at the balances, but you just do a general quick calculation and come up with your AFDA for the year, right? So there's two, there's a couple of ways in which you can do it. From a tax point of view, you cannot recognize any amount that's been determined on a general provision basis. So in other words, if you don't look at, for tax, you have to look at the specific balances and then conclude on what you believe is collectible or not. Okay, so if you just sit there and say, oh, accounting, we did 5% of sales, that was our calculation of how we determine our AFDA. Tax would say, sorry, that bad debt expense you recognize in your books, we will disallow it for tax, you can't recognize it. Okay, so you have to recognize on a specific account basis if you're going to recognize a reserve under 21L. You have to look at the account balances and make a conclusion on whether it is deductible or not. And the way you do it most commonly is say, oh, I looked at my AR aging, anything over 90 days, we have assumed we can't collect, and that's our bad debt. That's our 21L reserve, and that's acceptable. Okay, because again, that's something you can tie to specific account balances. Does that make sense? Okay. If you go to page 152, the notes to 21L is there. And again, under related provisions, you'll see it says 12.1D. Add the income inclusion in following year. So again, 12.1D is the provision that says take your 21L reserve, add it into income the following year. Okay. The last reserve you have to worry about for the course is 21N. Okay, 21N is similar to the capital gains reserve, right? It applies if you sell something and you did not get all your proceeds at the time of the sale. But there are some nuances or differences between 21N and the capital gain reserve. Okay, the first thing that's different is, in order to recognize the reserve under 21N, the balance there must be some uncollected portion that exists for at least 2 years. Okay, so in other words, it's not an issue. You cannot recognize the 21N reserve right away at the time of sale. Okay, you have to wait, and you have to sit there and say, is there a portion that still remained uncollected after 2 years? If the answer is yes, then you can claim the reserve under 21N. Okay? Another part about 21N is there's a time limit on the reserve. Okay? It's basically a 3-year time limit on the reserve. Okay? And lastly, if you look at the related provisions, and again, 21N is on page 153. If you look at related provisions, the provision that says you have to take this reserve, add it back into income the following year is 12 bracket 1 bracket E bracket 2 little I. Okay? Otherwise, in many ways, it is similar to how you calculate your capital gain reserve. So I'm just going to briefly talk about that one. And we do have a handout that goes into more detail. It is in your week 10 context that goes into more detail on reserves, but I'm not going, it's an old handout, but I'm not going to go over it too much in detail in class just because we're limited on time. Okay, so anyways, just keep that in mind. Okay, so general deductions. So again, turn to, now I'm going to go into 18.1a. Turn to 18.1a in your act, go to page 112. Throw me a note in chat when you're in page 112. And Gusan, just to answer your question, there's no set criteria in terms of what's a bad debt. It's just in your business view, what is a bad debt? For some companies, it could be over some 90 days. Some companies may do over 60. Some companies might say we'll do 100% if it's over 90. Bounces over 60 days, between 60 and 90 days, we'll do 50%. Right? It's just depends on the company's assessment. There's no specific rule. Okay, so if you look at 18.1a, it's a very simple wording. It basically says a deduction can't be, it says an outlay or expense except to the extent that it was made or incurred by the taxpayer for the purpose of gaining or producing income from the business or property, right? If you look at paragraph A. So basically what this is saying is you can only have a deduction, right? If you look at the preamble in 18.1 and then you combine that with the wording in paragraph A. Basically what they're trying to say is you can only have a deduction if it is made for the purpose of generating or producing income. Okay, so it's a purpose-driven test as to whether or not you are allowed a deduction. So 18.1a, you can use it to allow a deduction. You can use it to deny a deduction. Okay, and this is the general rule for expenses. If there is no rule that talks about a specific expense, then by default, you must go to 18.1a. Okay? So if, for example, you're in the exam, you're not sure, you're in a situation where you're not really certain of what's going to happen or what's going on, and you had to guess, the reality is this is the citation you would guess for expenses. This is 18.1a. Okay? Again, if there is no specific rule for a particular expenditure, then you must turn to 18.1a to determine if it's deductible or not. So if we look at life insurance, the question is this cost, in the example here, is this $3,500 a cost incurred to earn income? So when it comes to life insurance, if the life insurance policy is being taken out because a bank is making it a condition for receiving a loan, okay? Right? Because you have to think about it, right? Like say a small business comes to the bank and wants a loan. If that owner is the main driver of the business and that owner dies, from the bank's perspective, that business is dead. And then the question becomes, can the bank collect on its loan? So sometimes what a bank will say to a business is, well, for this business, because you're the driver, we're going to require you to take a life insurance policy, and you must make the bank the beneficiary. So if the owner dies, boom, insurance policy kicks in, the bank gets the policy, now it collects on the loan. Okay, does that make sense? So if that's the situation, then 18.1a says you can deduct the life insurance premiums. Okay. However, in this case, we say there's no banking or other requirement. So in other words, it's just, hey, we're taking a life insurance policy on the president, and the company's the beneficiary. Okay. So there's no business requirement. It's just, a policy that EMS is putting themselves. Well, in that case, because it's no banking requirement, there's no business necessity for this insurance. The government's viewpoint is this is not made for the purpose of earning income. This is not deductible. Okay, so in this circumstance, it's not deductible. So under our Section 1 method, again, accounting deducts the $3,500. Tax says no, you can't because of 18.1a. So you need to add $3,500 to income. Okay, does that make sense? Okay. Analysis of professional fees. Okay, for 2019, revealed the following expenses. You have legal and accounting fees related to issuance of shares, costs regarding the renegotiated bank loans, costs incurred to defend the company against wrongful dismissal. So for this one, I'm going to, again, need you to go into your act. The provision we're going to care about is called 20(1)(e). That is on page 148. Again, flip me a note in the chat to tell me that you got there. Okay, so page 148, expenses refinancing. Okay, so if you take a look, what this is basically saying is, if you incur costs to obtain financing, the reality is there's a longer term benefit. Okay, there's a longer term benefit because financing will enable your business to survive, not just survive, but could allow it to invest. And so there's a presumption that really there's a future benefit associated with these costs. Okay, so what tax says is, depending on, for certain types of financing activities, these costs are not going to be immediately deductible, but they're going to be deductible over time. So the first question is, well, what type of financing activities are captured under 20(1)(e)? So if you take a look at subparagraph 1, it says issuance or sale of units of a unit trust or in a partnership, or if you issue shares of the capital stock of the taxpayer. So subparagraph 1 says if you do equity financing, the cost that you incur to obtain that financing or to issue equity, that is covered under 21(e). Subparagraph 2 says if you are borrowing money for the purpose of earning income from a business or property. So in other words, if you do debt financing, that is caught. Then it says if you're incurring indebtedness, that is an amount payable for property acquired for the purpose of gaining or producing income. So again, this is kind of the same thing. If you are borrowing money, okay, but this might be in again, you're acquiring property, okay. So this is specific to acquisition of property. And then if you take a look at subparagraph 2.2, It talks about rescheduling, or more importantly, restructuring your debt. Okay, so this is why I'm saying it's not just about obtaining financing, it's just financing activities in general. So if you go equity financing, if you obtain debt financing, if you restructure your debt, all of those are captured under 20 bracket 1 bracket E. And if you go further into 20 bracket 1 bracket E and you look at subparagraph 3, basically what they're saying is you can deduct 20% of the cost per year. So in other words, you must deduct these costs that you incur to obtain financing over 5 years. Okay? And here's the key thing. If you have a short tax year, remember we talked about short taxation years, right? When we did CCA, right? Chapter 5. If you have a short tax year, you must prorate the deduction for that year. Okay? So the way the rules are worded, if you have a short tax year, you have to prorate your 20%. Okay? So that's 20 bracket 1 bracket E. So in this case, if I look at 3, the issuance of shares at 29.3, that would be caught. The renegotiation of the bank loan, that also would be caught. Okay? So both of those would be caught under 20 bracket 1 bracket E. So the two, accounting, if you take those two numbers, accounting deducted, right, these two, 75,400. Tax says, no, that amount, you can only deduct 20% a year, or you must deduct over 5. So tax says, no, you can only deduct 15,080 in 2019. Okay, so they're saying 2019 you deduct 15,080, 2020 you deduct 15,080, etc. So if you take a look at financing, that means for 2019 you must add back 60,320. Okay, and again, if I were to look at future years, like say in 2020, you would be at 0 for accounting because it was already all deducted. But tax would say, oh, but you deduct. Again, you have to deduct another 15,080, right? Because again, this is going to be deducted over 5 years, and so now for financing in 2020, you're going to have a deduction. Okay, but again, in the initial year, 80% of this cost basically needs to be added back. Okay, any questions there on 20 bracket 1 bracket E? So Seema, don't stop right there. Remember, I said it's about taxation year. Doesn't matter when you obtain the financing. You could incur the cost. You could have a December 31st year end. You incurred the cost on December 1. Doesn't matter. It's 20% per year. The only time you prorate is if your taxation year is a short tax year, and that's different. That's not based on when you obtain the financing. Right? Remember, if I create a business, right, in a year, and I say I create a business in June 1st, and I set the year into December 31st, right? That's a short tax year. Right? So it's about you prorate only if your tax year is short. It's not based on when you obtain the financing in the year. Okay. Okay. Any other questions on 20 bracket 1 bracket E? Okay. So in the case of the cost incurred to defend the company against wrongful dismissal, that would be a general. Then you'd say, is there a specific rule for this? No, not really. So now you have to turn to 18.1a. So again, is this a cost that you incur to earn income? Well, you're trying to defend the company against wrongful dismissal, so for sure there's an income earning purpose around this expenditure. So the answer is yes, this would be deductible under 18.1a. So here, for example, accounting would deduct the cost. Tax would also deduct the cost pursuant to 18.1a. There's no adjustment. On the final, where you have a situation where both accounting and tax have the same, would do the same thing, and there's no reconciling item, you must indicate NA. You must say not applicable. There is no reconciling item. So in other words, for every item in the exam, you need to hard conclude how would you treat this. Okay. So you're always, remember, when you're doing this reconciling, you're always saying, how would accounting treat an item? How would tax treat an item? What is that difference? If there is no difference, you need to say there is no difference. Okay. If you don't hard conclude on it in your response, there will be no mark granted. Okay. So you cannot be silent on things. You have to be explicitly concluding. Okay. So I want to make sure that's really clear for the exam. Okay, item number 4. There were substantial repairs completed to the outside of the building. After the repairs, some of the landscaping had to be redone. The total costs were $139,000. Of this, $23,500 relates to landscaping cost. The entire $139,000 was included in G&A expenses. Okay, so first off, let's look at this landscaping. If you were following traditional GAAP, how would you treat this landscaping cost? Okay, if you were following ASPE or IFRS, how would those landscaping costs be treated? Would it be a deduction? So Abdurzak says maintenance expense. Gusan says building. So when you say building development, what do you mean, Gusan? Are you saying it's an expense? Are you saying this is capitalized? Would it be capitalized the cost, or would it be expense? Because your response, Gusan, is a bit vague. Okay, so Gusan says capital. How about anyone else? Like, I've only got Abdurzak and Gusan who said something. What does everyone else think? Let's get some more thought. Does everyone, like, when we say landscaping, what could be landscaping? So just think about it for a second. A lot of times when people think landscaping, we're not talking about the guy that comes in and mows your lawn. Okay, we're not talking about that. Landscaping could be things like, for example, a retaining wall. Someone puts up a retaining wall, and that would be considered landscaping for the premises. So if you think about it in that respect, is that capital or is that expense? I guess, like, here's a better way to put it. If I build a retaining wall, is there a future benefit? Does this thing last? Yeah. So accounting, normally for accounting purposes, landscaping is a capital cost. Okay, because again, we're not talking about general maintenance like mowing the lawn or trimming bushes. You're actually putting in stuff that's going to last. So typically it's capital in nature. Now, in this case, this is an example of you do not have to follow GAAP for accounting, right? The accounting, your starting point is whatever you want it to be, as long as you don't violate the rules of the act, okay? So you could have a situation where we tell you accounting is not capitalizing it. Like GAAP might say you capitalize it, but for whatever books you're looking at, it could be those books are not capitalizing it. So here, $23,500 has been expensed. So now the question is, what does tax say about landscaping costs? So the provision is on, you don't need to flip to it, but I'll just mention it. The provision that we're talking about here is 20 bracket 1 bracket double A, so AA, It's page 156 of your act if you want a tab. But that provision basically says landscaping costs are deductible. Okay. So in other words, tax says we would treat this 23.5 as a deductible cost. Okay. Of course, the difference between the 139 and 23.5 is just general repairs. Well, there's no betterment there, right? So tax again would just say, look, under 18.1a, that's a deductible cost. Okay. Because again, you have to, generally speaking, it is appropriate for you to maintain your property if you're running a business. Okay. So that's considered a business cost, and that would be deductible. So again, for the landscaping, because of 21 bracket 1 bracket double A, it would be deducted for tax. It was deducted in the accounting books. There's no difference, no reconciling item. Under repairs, again, same thing. Under 18.1a, accounting deducts the 115.5, the residual, right? 139 less 23.5 is 115.5. Tax would also deduct it. Again, there's no reconciling item. Okay, does that make sense? Okay. So I'm not going to keep showing this presentation now. I'm just going to go through the rest of the handout and explain the rules. Well, this is a calculation of your income. This is separate. It's not a label. This is just your income. Remember, the whole point of this is at the end of the day, you're trying to get to your net income for tax purposes. You're just calculating income. Okay. I'm just showing on this side, how do you come up with your adjustment? I'm just showing you this format. And the reason I'm doing it this way is because in the past, I thought I didn't even have to show this, but for students, a lot of students have said to me, actually, they thought this was helpful. So based on feedback from students, I'm showing it this way. I mean, maybe the people who have taken the course before, maybe you can tell me, do you think showing it this way is helpful to you? Like for those who have taken the course before. Does this table actually help make things more clear? Harrelson says more clear, but how about the others? I know there's a number of you guys, right, that are retaking. So again, does this table help? Or doesn't matter? I guess that is the question I'm asking. So for some people, does it matter at all? Not seeing anything in chat, so I'm not. I love the dot from Abigail. Makes me wonder if it really is helping. Anyways. Okay, so people think. Anyways, so I'll leave you guys with that if you want to use that as a tool or not. But I'll be going through the rest of the handout without typing it all out. Number 5, a review of the other expense accounts included in G&A indicated has these following items. Number 1, amortization. So you have to remember, right? We learned in chapter 5, right? Under 18.1b, accounting amortization, capital expenditures are not deducted, right? They're not deductible under 18 bracket 1 bracket B, not deductible because we have the CCA regime. Okay, so if you say again, accounting deducts amortization, what does tax say? Tax says nothing. So you're going to have an add back of 4.56 million pursuant to 18.1B. Okay. The next one, interest on late payment of municipal taxes. This one, the provision that is specific to this is kind of confusing. So what I'm going to ask first off is, just so people have the provision in front of them as a reference, you can turn to 18.1T in your act, and that is on page 118. Okay. People can throw a note in chat when they get there. Page 118. Okay. So 18.1T it talks about how do you handle amounts that are required to be paid under the Income Tax Act, the Excise Tax Act, which is the GST Act, and this Air Travelers Security Act. Okay. And basically what this act says is, if you are charged, say, tax expense under this act, if you get charged interest or late penalties under this act, under the Income Tax Act, 18.1T says those are not deductible. Okay? You cannot show those as a deduction. The problem with saying that is, well, you have there's federal income tax, but what about provincial income tax? Okay, we know BC has an Income Tax Act. Now the CRA administers it, but legally that's a different act. And what about municipalities? Right? Municipalities, you have to pay your property tax. What happens if you get dinged with interest because you were late paying your municipal taxes? So what the government said is this: 18.1T only applies to federal taxes. So if you get charged interest on late installments, right, based on the Income Tax Act prescribed rate plus 4%, that is not deductible under 18.1T, for example. Okay. If we're talking about provincial income tax, and remember, this is a tax for most of the provincial taxes. CRA is also responsible for administering them. Okay. The answer is not deductible. So if you have interest, if say you're getting charged interest on your provincial income tax, okay, that is not deductible under 18.1A. It is not considered to be a cost incurred to earn income. For municipal taxes, the answer is it is deductible under 18.1A. So in other words, it's confusing because you would think that the government would be consistent in its treatment for all the taxes. And the answer is no, it's not. It is not consistent. Basically, if the CRA is going to be responsible for the administration of the tax, then in some way, shape, or form, any interest, late payment, or income tax amount owing is typically non-deductible. Okay, not a deductible item. But for something like municipal tax, where the government is not responsible for administrating it, then typically they will treat it as deductible. Okay, does that make sense? And to help you out as well, if you look at the notes under 18.1T, okay, you will see in the first two sentences, it talks about federal and talks about provincial. Okay. So there's some notes there to help you for the first bit, but just keep in mind, in general, there is an inconsistency. Okay, does that make sense? Any questions there? Are you all good? And again, this is just something you're gonna have to memorize. I'm not telling you that it's all logical. You're just going to have to memorize it is the answer. Okay. Anyway, so we'll move on. So again, for this one here, pursuant to 181A, accounting deducts the 900. Tax would allow you to deduct this 900. There's no reconciling item. Okay. Severance payments to 4 managers. Again, accounting deducts 245. Tax, is there any specific rule? No. So then the question becomes, is this a cost to incurred to earn income? I would say that is a regular cost of doing business. So I would say, yes, it is. So again, accounting deducts 245. Tax is deducting 245. No reconciling item. Okay. Loss from theft by accounting clerk. Again, is there a specific rule for this? No, there's not. Okay. Is this a cost incurred to earn income? Well, loss from theft. Well, that's a cost of doing business. Okay. You're going to have some theft if you go into business. So the answer is yes, that's a cost, a business cost. So again, accounting deducts 45. Tax would deduct 4,500. No reconciling item pursuant to 181A for loss from theft. Donation to various registered charities. So you have to be careful, okay, when it comes to donations, because a lot of times people are confused. For individuals, so for individuals, like, you know, when you do your own personal tax return, if you do a donation, you get a tax credit, right? So individuals, they do a donation, they'll get a tax credit. If you're a corporation, okay, the rule is for the purpose of calculating your net income for tax purposes, charitable donations are not a cost incurred to earn income. Therefore, it is not deductible for the purpose of calculating NITP. Okay, so in this example, because the end result is the end goal is to calculate NITP, this amount would be not deductible. So accounting would deduct 57,000. Tax says 0 because it is not incurred to earn income. So pursuant to 181A, you have a 57,000 add back. Okay. However, for what happens when you're a corp is donations are deductible for the purpose of calculating taxable income. Okay. So you can deduct them, but for taxable income calcs, not for NITP. So for taxable income, you can deduct charitable donations, but there is a limit. The limit is you can only deduct up to 75% of NITP. Okay, so the 57,000 charitable donations, only 75% of your NITP, like you have to figure out what your NITP is, calculate that threshold, and then you can only deduct charitable donations up to that threshold. Okay, so again, charitable donations, not deductible because it's not a cost incurred to earn income for the purpose of calculating NITP. Okay, any questions? Marie, are you good? Because I did reiterate it for you. Okay. Is everyone else good? Okay. Number 6, early November 2019, M announced an early retirement package that was made available to employees over the age of 60. Okay, in order to provide employees with time required to assess the offer, the deadline was set at February 15, 2020. At the end of 2019, you didn't get any confirmation, but people expected a high acceptance rate, and they booked $672,000 in the financial statements as an expense. So my question is, what is this from an accounting point of view, first off? What is this? What is this? Benefit? From the company point of view, is this a benefit? Not sure about that one. What type of item, like what would you call this on your financial statements? Payable? What's the problem by saying this is a payable? Like, do you have a legal obligation to pay this amount? Like, is this a true liability really from an accounting point of view? Like, do you have an obligation to pay the 672? Because what's the problem? Do you have any employees that have accepted the package? So if they haven't accepted the package, do you have a formal obligation to pay the 672? I would argue the answer is no, you don't. So then what kind of liability is this? It's not a normal liability. What is this? It's a contingent liability. That's right. Right, because it's contingent on these employees accepting the package. So the question is, how does tax treat contingent liabilities? Okay. So what you need to do is go to, again, the rule. I'm going to make reference to it. I'm not going to go and make you flip to it, but for those who want a tab, the rule is 18.1e. It is on page 115 of your act. Okay. 18.1e, what it says is you cannot deduct any amount that is an accounting reserve or an accounting contingent liability / sinking fund unless it's been permitted in the act. Okay. So in general, accounting reserves, accounting contingent liability. So if they incur, if they recognize an expense but it's relating to a contingent liability, those are not deductible. Okay. So in this case, 672 accounting deducts 672. Tax says no, you cannot. So tax says 0. You're going to have a 672,000 add back pursuant to 18.1e. Okay. Does that make sense? Okay. Note number 7, cost for various items here again. Cost of sponsorship presentations at a local theater company. Again, is there a specific rule? No, there's not. Okay, well, then is this a cost incurred to earn income? Well, arguably, this is like advertising, right? You're doing a sponsorship of some local theater company event or whatever. This is probably considered advertising. So therefore, you would say, yes, that's a cost incurred to earn income. So for this sponsorship, again, accounting deducts it. Tax says, yes, it is a cost incurred to earn income. It's deductible. There's no difference, no reconciling item. Okay? You're starting to get a sense of why I say 18.1a is like it's kind of like your C in multiple choice, right? When you don't know, that's what your guess is, right? Because this is very prevalent right? It's very commonly used. Advertising in a U.S. magazine aimed at the Canadian market. So what I want you guys to do is turn to section 19 of your act. Okay, so if you turn to 19 of your act, oh shoot, my tab fell out. 19 is on page, if I can get there, is on page 141. Now, what I want you to do is I want you to take a look at, if you flip through a little bit, 141 talks about news, page 141, section 19, subsection 19, bracket 1, you'll see there's a discussion of newspapers, okay? If you flip to 19.1, bracket 1, it talks about broadcasting, okay? And also, if you go into, and I believe it's called 19, if you look at additional rules in 19, in 19.01, bracket 2, you'll see the word periodicals, okay? So, does anyone know what periodicals are, by the way? When we say a periodical, what does that mean? I think for some of you guys, you won't know what that means. Does anyone, like, who does not know what periodical means? Or does everyone know what a periodical is? She doesn't know. Okay. Oh, God. All of you are saying you don't know. Does anyone know what a periodical is? Daily Mag. See, the problem is right now, using that term might be dating myself here. It feels like. Anyways, basically, a periodical is any publication that is issuing on a periodic basis. So it could be like a magazine. It could be like if there's regular brochures, it could be in arguably a brochure if you produce one on a regular basis. But if you take a look at 19.01 and 19.1, right, we talk broadcasting, we're talking about magazines, you're talking about newspapers. This is what I call old mediums or traditional advertising mediums, right? Because there's nothing here that talks about internet, for example, right? A lot of times now people will advertise through Facebook or Google, right? Those are not covered under these provisions, okay? And what the provisions for 19.01 and 19.1, what they are trying to do is they're protectionist measures. They're trying to, if you want to advertise to the Canadian market, those parts of the act are trying to get you to advertise it in a Canadian medium, okay? So what basically the rules are saying in general is if you are targeting the Canadian market and you use a foreign traditional medium to advertise to the Canadian market, so newspaper, magazine, broadcasting, we will not allow, if you use a foreign medium, it is not deductible, okay? So in this case, because you use a US magazine to target the Canadian market, pursuant to 19.01 bracket 2, not deductible, okay? Now, to make your life easier on the final exam, because these rules are not as commonly used now, I will accept if you just say section 19 as a whole, okay? So rather than force you to say, Chris, it's 19 or 19.01 or 19.1, as long as you tell me, no, foreign medium, aimed at Canadian market, not deductible, I will accept if you just tell me section 19. Okay? So this is just an administrative just it's administrative concession to make your life easier. Okay, so I will accept just section 19. Okay, does that make sense? Again, if you're targeting a foreign market and you use a foreign medium, that's fine. It's only an issue if you target the Canadian market. And there are some specific exceptions and all that to these rules, but we're not going to talk about them because again, these are not rules that are as commonly used as before. What do you mean by there is no difference? Like in what context, Sarah? No, there is, because this is targeted at the Canadian market. So accounting deducts the 46, tax would say 0. You have a 4,600 add back. Right? Again, we're trying to protect the Canadian market. We want you to use a Canadian medium to advertise the Canadian market. I said there is no difference if you're targeting a foreign market. So if I use a US magazine to target the US market, that's not a problem. That's fine. If I want to target Canadian market, that's a problem. That kind of makes sense, right? So, okay. Any other questions? Are we all good? Sorry. So I answered Sarah's. Is everyone else fine? People are good. No one else. Okay. Well, I'm going to move on anyways. Hockey game tickets given to customers. So again, this is now, right, meals and entertainment, right? So what I want you to do is I want you to turn to 67.1, bracket 1 in your act. So that's page 377. So again, flip me a note when you're there, page 377. Okay. So the way this works, okay, if the amount for a meal or entertainment item is reasonable in the circumstances, then 67.1, bracket 1, bracket A says 50% deductible. Okay. So for example, in this case, the hockey game tickets, if that 8,000 is reasonable amount to pay, and so in this case, let's say for example, you're paying the face price of the ticket, then 8,000 times 50%, 4,000 is deductible for tax. Okay, so 4,000 deductible for tax, 8,000 was deducted by accounting, so there's a 4,000 difference. You're going to have a 4,000 add back pursuant to 67.1, bracket 1, bracket A. Okay. If you look at the next line, meals and entertainment costs of salespeople. Okay, so in there we say it's 109.5. Now, if you go to the bottom of 7, it says, note, should CRA review the expenses incurred, they would consider 100,000 as being reasonable given the circumstances for meals and entertainment for salespeople. Okay, so what kind of situation could this be? So imagine you're a salesperson, you fly out and you're going to a company meeting, okay? And now you're going out to a restaurant, okay? And you're gonna get reimbursed by the company, okay? If the company, right, that salesperson, if they go to like a Cactus Club, okay, and they spend $30 on dinner, okay, $35 on dinner, then that would be reasonable. You'd say, okay, that's fine. That's fine. But what happens if that salesperson, instead of going to Cactus Club, says, I'm going to go out on the company dime. I'm going to go to High's Steakhouse. I'm going to get this fancy $100 steak, and I'm going to get some wine, and I'm going to get a whole bunch of sides. So you end up spending 180. Say they spent $200 on dinner. just to go to a company trip. CRA would say, well, that's unreasonable. That salesperson did not need to go to some fancy restaurant. Okay. So they may say that's unreasonable and deny a portion of that expense. Okay. So that's kind of the circumstance that, for example, you might face. So the way the Act says is, if you have an unreasonable amount being expensed, like we do in this situation, you would only be allowed a 50% deduction of the reasonable amount. So in other words, tax says 100,000 is reasonable in the circumstances. 50% of that, only 50,000 would be deductible. So again, accounting deducted 109.5, tax would only deduct 50,000. So pursuant to 67.1 bracket 1 bracket B, you have a 59,500 add back. Okay. So again, paragraph A applies when the entire amount is reasonable. If an expenditure has an unreasonable portion, then paragraph B would apply. Any portion that is unreasonable, 100% not deductible, and only 50% of the reasonable portion is deducted. Okay? Does that make sense? And in the exam, you would have to be specific. You have to tell me the exact paragraph that's applying if it is in the exam. So Seema says yes, Sarah says yes. Anyone else? Yeah, we need more people typing regularly in the chat. Okay. Staff Christmas party, summer barbecue. Under 67.1, bracket 2, bracket F, that's on page 378. Okay. The Act says companies can have one of 6 special events in the year where they invite all employees. Okay, so you have to invite all employees. And where you're providing meals and entertainment to employees at these events, 100% of the cost is deductible. So in other words, it's exempt from the 50% meals and entertainment rule. Okay, so again, one of 6 special events in the year, and all employees must be invited. So in other words, like a Christmas party, if the company does a kind of like their State of the Union address, where they invite all the employees to get together and they talk about where the company is at. Another thing that they sometimes will do is they'll do a summer barbecue type event, right? Just depends on the company. Again, the key thing is you have to invite all employees, and you only get 6 of these events in a year. Also, from a logistical point of view, say, for example, a company like Fortis, you have employees throughout the province, right? We have employees out in Kelowna, we have employees out in Prince George, you have employees here in Vancouver, you have employees out in Surrey, etc. It's difficult to try and assemble all the employees in one location. So in a circumstance where you have employee, like say, for example, Fortis says, we'll do an event for employees in Kelowna, for employees in that region. And we'll do another Christmas party event for the Lower Mainland and have all the employees in the Lower Mainland attend a party in Vancouver. Even though those are 2 separate events, they're both Christmas parties, and it's both in an attempt to ensure that all employees are invited to an event. So given that circumstance, that would just constitute one event. Okay. Again, you're trying to do a Christmas party thing for all the employees in all these different locations. Even though you're holding events in all these different locations,
collectively that is considered one event. Okay, so you don't burn your 6 right away just because of logistical or geographic reasons. Does that make sense? So again, tax says accounting deducts 43.8. Tax would deduct 43.8 pursuant to 67.1 bracket 2 bracket F. Therefore, no reconciling item. Is that clear? Okay. Cost of sponsoring local Little League teams. Again, this is the same thing as before, like the theater. That's just like advertising. So again, that's the cost of doing business. That's deductible under 18(1)(a). So again, accounting deducts 5,000. Tax does deduct 5,000. No difference. No reconciling item. Okay. Membership for salespeople at local golf courses. This 5,700. Maybe I should just to make it clear. I should maybe do that. So in this case, $5,700. So again, pursuant to 18 bracket 1 bracket L, similar to employees, this is not deductible. Memberships in recreational dues and facilities, not deductible for tax purposes. So accounting deducts 5,700, tax says 0 pursuant to 18(1)L. You have a 5,700 add back. Okay. Convention expenses. The rule for convention expenses is under 20 bracket 10. So this one probably is worth flipping to. So why don't we do that? So 20 bracket 10 is on page, oh no, I lost my tab on this one too. Bracket 10 is on page 163. So just let me know when you get there, page 163. Okay. So the way there's two aspects of this that you have to make sure you capture when it comes to convention expenses. Number one, and this is about cost for attending conventions, right? So we're not talking about a company buys a booth in a convention and is kind of advertising the convention. This is talking about attending conventions, okay? So to attend conventions, maximum is 2 per year, okay? So maximum is 2. And obviously, you should be selecting the 2 highest ones, right? Like if you give me 2, if you say to me, Chris, we're going to deduct the 2 lowest ones, you're not going to get the mark, okay? It's supposed to be the 2 highest ones. Second of all, the convention must be what they call must be within the territorial scope of that organization. So in other words, you can't try to attend a convention in an exotic locale and kind of use it as like an excuse for a mini vacation and get a deduction for it. Okay, so when we say territorial scope, what do we mean? So if you look at the very beginning, okay, let's just say, I can't remember if we said this specifically in this question, maybe not. Let's say, for example, for Mary's widget manufacturing, let's just say Mary's sells widgets to customers in North America. Okay, let's say Mary's operates just within North America. So then you would say the territorial scope of Mary's widget manufacturing is North America. So, for example, if there's a convention in Rio de Janeiro in Brazil, that would be not within the territorial scope. But if you said, oh, there's a convention in Phoenix, well, because Mary sells to North America, and Phoenix is in North America, that is considered within the territorial scope. Okay? So only if a convention is within the territorial scope is it considered a deductible cost. Does that make sense? Marie says yes. No, can you explain one more time? So again, territorial scope is where does your company operate in? If Mary's Widget Manufacturing sells to North America, then the territorial scope is North America. So that means in order for a convention to be considered the cost to attend a convention, you know, to determine whether or not that attending cost is deductible, it must be within North America for Mary's Widget Manufacturing. So again, Brazil is not North America. So if you have a convention in Brazil, that's not deductible at all, period. If it's in Arizona, then that could be deductible, right? Again, subject to the 2 maximum. Does that help? Okay, Seema says fine. Good. Anyone else? They're all good? Harrelson was good. Marie was good. Seema's good. Durzak, wait. Okay. Didn't mention. Well, again, it's about the company. It's a company. So it's about where is the company based and where is the company's activities focused on. So it's not about the employee, it's about the company. Okay. Okay, and remember, subject to the 2 maximum. So again, in this example, the 2 highest is the 2,322. So assume everything is within territorial scope. Tax would deduct 4,500, right? Accounting deducted 7,000. So you're going to have a 2,500 add back. Okay. Number 8, other income includes a loss on the sale of various depreciable assets of 35,900. So the rule that you have to think about here is 39.1 on page 201. Okay. Basically, 39.1 is the provision that defines what is a capital gain and what is a capital loss. Okay. So accounting gains or losses are not recognized. Okay, they're not recognized pursuant to 39.1. Now the question becomes, what paragraph of 39.1 applies or does not apply? So 39.1b, right, 39 bracket 1 bracket b, that provision defines what is a capital loss. So when it comes to number 8, and you say what provision denies this accounting loss from being recognized, we would argue 39.1b would be the provision. So you would say, because 39.1b dictates what is a capital loss, accounting deducts 35.9, tax is 0 pursuant to 39.1b, therefore you have a 35,900 add back. Okay. If it was the other way around, let's say they said it was not a loss for accounting, they said it was a gain for accounting. If they said it was a gain for accounting, then what you would say is 39.1a defines what is a capital gain. So therefore the accounting gain, 35,900 is added to income for accounting purposes. Tax would say 0 because of 39 bracket 1 bracket a. Okay, so again, Accounting gains or losses are not recognized for tax purposes because there are separate provisions for calculating what is a capital gain or loss for tax. Does that make sense? For number 8? Okay. I'll keep going then. Number 9, CCA. You calculated that 5.835 million of CCA can be deducted in 2019. Well, we taught you in chapter 5, CCA is 20 bracket 1 bracket A. Therefore, you would say accounting is 0. Tax says 5.835 can be deducted, right? 5.835 million can be deducted pursuant to 20 bracket 1 bracket A. You're going to have a 5.13 or 5.835 million deduction. Okay. And number 10, we already talked about this in reviewing the income tax assessment. M had been charged interest of $4,900 in late payment of installments. That amount, again, not deductible pursuant to 18.1T, because this is federal tax that it's relating to. So 18.1T, not deductible. Okay. So the summary of all the things that we discussed are at the end of the handout. Again, we've talked about these in a bit more detail when we were going through them in class. But again, you can refer to this in case you missed anything. Okay, so there's this summary here. Okay, now this handout that we have given you covers most of the items that you are responsible for the final. There are a couple additional items that we did not cover, but they will either be part of your homework or we just expect you to be able to deal with them for the final exam. Number 1, things that you learned in chapter 5, I'll call them basic things, such as recapture, terminal loss, CCA as a whole. Those provisions or citations that we have given you, like 20 bracket 16 for terminal loss, 13 bracket 1 for recapture, those you are still responsible for in the big chapter 6 question. You need to be able to identify those. Okay. Number 2, interest expense. If a company incurs interest expense, the rule that governs whether that interest is deductible or not is 20 bracket 1 bracket C. We briefly mentioned this before in the employee loan context, but we're going to, again, you have to deal with this when it comes to business income. So again, if you go to page 145 of your act, that is 20 bracket 1 bracket C. Basically, if you incur interest for the purpose of earning income, and again, we're just going to talk about this in the general context, it is deductible. Okay, there are much more layers of complexity around interest expense. We're not covering it for this class. All you need to know for your final is if it's incurred for the purpose of earning income, it is deductible. Okay, and lastly, there is under section, I think it's under section 67. Sorry, I just want to make sure I'm going to the right spot. Just bear with me for one minute here. Just trying to get to that page in the act. So 67.5 bracket 1 talks about non-deductibility of illegal payments. So where you have an illegal payment, for example, a bribe, that is not deductible under 67.5 bracket 1. And there was a time I had a client, for example, where we were doing their review, their SOX control review, and it was a mining company, and they had mines in China. And we said to them, "All right, don't give us some BS. Where are you guys recording the fines that you guys are paying to officials in China?" And at first they were kind of saying, "What are you talking about?" I said, "Come on, this is China. You guys have to be paying something." And they disclosed to us that they did pay for the education of certain officials' kids. So that's an example where that would be an illegal payment, not deductible, pursuant to 67.5 bracket 1. Okay, so illegal payments not deductible. Also, 67.6, non-deductibility of fines and penalties. If an amount in any way, shape, or form is defined as a penalty, okay, then pursuant to 67.6 bracket 1, 67.6, generally speaking, not deductible. Okay, so those are the additional provisions you are responsible for the final that was not covered in the example. So section 67.6, I should give you a page number. That's 381 of your act, right? 67.7.5 bracket 1 and 67.6. These are on page 381 of your act. If something is described as a penalty, okay, or a fine, that amount is not deductible from a tax point of view. Is that good, Harrison? Okay. Okay. So there you go. That is chapter 6. It is lots of very small rules and lots of memorization. But you just have to remember the key tenet. When it comes to expenses, if there is no specific rule for that expense, you must go back to 18.1a. And 18.1a says, if a cost is incurred to generate income, for the purpose of generating income, you can deduct it. If not, you cannot. Okay? And other than that, you're just going to have to memorize all the specific rules that are there. And in general, the way the chapter 6 question has been structured in the past, typically it is half mark for the adjustment, half mark for the correct citation. Okay? We have not yet determined exactly what the final exam will be. I'm still waiting to see if there will be any guidance, but generally speaking, chapter 6 is worth a fairly sizable portion of your final. Okay. There's one last bit to go over. What about tips? Well, tips is just considered part of the meal and entertainment cost. So that's just 50%. It's 50% off the whole bill. What do you mean by is it fair for amount of time? All I will say, Abigail, is fair is what we think is fair. Fair is a subjective question. Is it going to be half and half? No. It's not been determined. So we will see. It could be more, it could be less. I will just say this to you. There will be an intention that the Excel portion will be time pressured, just like on the midterm. So you have to remember, guys, there's two ways you combat cheating. You either make it so that if you try and cheat and review resources, you're going to pay because you don't have enough time to answer the rest of the question. So it penalizes, you create an exam that penalizes people for not knowing the material up front. Right? There's two ways to do it. Or you can try to do all sorts of scrambling and all sorts of other things to try and combat it. So we'll see. One last topic before we close for the day, and then I will maybe give you some more general tenets on how we're going to look at this exam and how we're going to deal with next week. The one last piece that the course we like to talk about students, or we like to give you an introduction, I should say, is farming. Okay, farming is considered a very important part of the economy for Canada, and because of the business challenges, farming has a whole bunch of dedicated rules. And there's certain things that they're allowed to account for more on a cash basis versus an accrual basis. But for this course, we don't want to go into all that detail. All we want to do is just give you an introduction just more to farming losses and how they are handled. Okay, so first things first, there are three types of farmers you kind of have to look at in the Act. There's what I like to call real farmers. These are 100%, they dedicate all their time to farming. Okay, so farming is what they do. It's what they do. It's their only thing, and they're definitely trying to do this to earn income. Okay, so I like to call these real farmers. Okay, and for them, there's really no restriction on how they deal with their losses. You have what I call hobby farmers. Those are like your mom and your dad. You go out to your garden, you plant some vegetables. You're not really trying to make money off of it. You make vegetables. Some people grow them and they cook it at home and eat it themselves. Some people, they grow them and they give it to others as gifts, right? There are lots of people that do that, right? Like my in-laws give us, vegetables and stuff that they grow from the garden all the time. Okay. So, so you have what I call these hobby farmers, okay? Basically for them, whatever losses you incur, not deductible. Sideline farmers. Those are, I'll call them the in-between farmers. This is, I would say, the most complex situation because these farmers, they are trying to earn income by doing farming as a side activity, but it's not their chief source of income. Okay, it's only a side source. So they are trying to earn income, but it's not the main thing they do. Okay, so then in this case, where you have a sideline farmer, the government says, oh, hold on a second, for you guys, because you're not trying to devote all your time, we're going to put some restrictions on how you can utilize farming losses. Okay, so for sideline farmers, what the government said was, the first $2,500 of losses, that is 100% deductible. Okay, first 2,500, 100% deductible. The next 30,000, we're only going to let you deduct half. Okay, so now after the first 2,500, there's restrictions. So half, of course, is 15, right? Half of 30 is 15,000. So in total, in any given year, the maximum you can deduct is 17,500. Okay. Anything over 32,500, right? Again, first 2,500 you can deduct in full. Next 30,000 only half. So any additional loss above 32,500, you cannot deduct in the year. Okay? Anything that you cannot deduct is considered what we call a restricted farm loss. And again, it's almost like a non-capital loss. You can only use those against income in other years. Okay? So, and we call these non-deducted losses, we call them restricted farm losses. Okay? So for the course, this is all we want you to worry about. Okay? We don't want you to worry about anything else. We don't want to get you into too much detail. We just want to get you started. Okay? So that's the only thing you need to worry about farm losses. Okay? Any questions on the farming, and then I can talk a little bit more about what will happen in the future. Okay. So in terms of the future, next class we will go over the homework. The only thing that I will tell you now that is 100% certain is that we will go over the homework. After that, there may be a quiz. So part of this is dependent on if we finalize the form of the final, or at least get a better feel for what the final will look like by next class. Okay. Again, there are some conversations that are being held, but again, this is considered more of a unique circumstance. What happens this semester is, in many cases, will not necessarily be consistent with what you would see in future semesters. Okay, so there's going to be a question of, how exactly will we do this final? Because for all I know, there may be some consideration, maybe not necessarily next semester, but at some point we're going to go back to the classroom. So how do we want to handle this final exam? So that's still to be determined. So we will try and do, I have stuff that I've prepared in the past. We may still use that because it is a way to help you prepare for the exam. But if someone was to ask me what's the best way to prepare for this final, it's the same thing as I've said before, right? Chapters 5 and 8 and ABLES. Like, you really have to know your triggers, and you really have to have good steps, and you really need to have a good process. Okay? So, and I've shown you how I use steps before in multiple cases. I even went through how I did it in the exam scenario. To me, that is still the best way to prepare. Chapter 6, that's just a memorization fest. It's one of the parts of this course where there's really not much complexity to the rules. You really just need to just understand how to reconcile, and then just memorize the rules. Okay? And then for me personally, especially when it comes to chapters 5 and 8, I really like creating my own questions, right? Because it forced me to understand what are the facts, key facts. And it may force me to make, by documenting my solutions in full and showing all the steps, it forced me to make sure that I understood how to do each individual step. So if you're asking me what's the best way to study, for me personally, it's always been creating my own questions and then creating the solutions to that. That is really the best way. Okay? And you have to remember, as an instructor, when we create exams, we're always going to ask ourselves, okay, how can we make you guys show your knowledge? We're going to take things, maybe we'll put two topics together, and we're going to sit there and say, can you see how these interact when we put two topics together? Okay, we may say, let's take an example and just go all the way, right? Because some topics like change in use, we've gone over it in detail, and they're very long topics. So maybe we'll take an example and just go all the way. Okay, so there are a number of ways we can challenge you in terms of an exam. So the real issue is you just need to have your toolkit ready, and that's to me the best way you're going to study for the exam. Okay? You guys have seen we will likely fire something at you that you've not seen before in some way, shape, or form. That's the whole point of trying to make you guys think. So, you know, just take it for what it's worth. Any questions there? Again, you guys, this is, I think one thing you guys just need to keep in mind is, again, for me, this is the very first time I've taught the course entirely from a remote environment. For BCIT, this is not standard practice. As an institution, we didn't design our courses to be taught solely remote, right? Like it's, you know, it's only because of COVID-19 have we been required to go this way, you know? So, you know, if, you know, for example, how long it takes to teach the classes, you know, we try and budget time and try and approach things the way we think it's going to work out. But you never know, right? Like there's always things that certain things take longer and some things you don't appreciate. You know, all I can tell you is for me as an instructor, it's been a pleasure to teach this group. And I hope that I've been able to be effective in teaching you, you know, the material and also how we want you to learn. And I'm hoping, my goal has always been when I teach this class, not just think about the immediate, but teach you in a way that helps you in the future. So, you know, I would just say, I don't know if they're going to do the normal standard course surveys. I've not been told if that's the case. But if you have any feedback, especially around how to teach the course online, what you thought was good, what you thought wasn't good, you know, it would be great to let me know. Because again, as we teach in the future, we're going to modify how we teach the course, and we're going to do different things. And so it'd be great to hear from you guys what you thought worked well and what you didn't think worked well. And if you're someone who's taken the course before with someone else, again, tell me whether or not some of the things that I do differently work better for you or don't work better for you. Again, the feedback is helpful, especially in the context of an online environment. As an institution, I don't know what they're going to do in the future. I don't know if we're going to be in a case where maybe in the future we're going to look more at simulcasting. We may be at a point in time where maybe we're going to try and record more. Like I will tell you now, next time I teach the course, we're probably going to do a mix of pre-recorded and not pre-recorded stuff to see if that works better. You know, but again, this is one of those, I'll say, unplanned circumstances where this is the first time we're teaching the course online. So I've given you guys all I can give you right now. I really hope that people had a fun time with the course. Obviously, we tried to teach stuff not just specific to the course, but teach you things that are useful for you in your personal life. So I'm trying to make the course relevant to you, especially around those projects. So hopefully I wish you luck there. And again, for this assignment, this is a long assignment, but please bear in mind, this assignment is pretty comprehensive. It will help you review what you need to do, what you need to know for the final. So again, we will go over it in detail next class. Any questions or any comments? Well, that looks like seems like everyone's good. So with that, I just want to say thank you guys, and we're dismissed. So I'll stay around here for the next minute or so in case anyone has questions on that they want to ask specifically. But let's see, 811. So which part of 811 do you want to? Well, I'm going to see. Here's the main part of 811. Oh shoot, I forgot. I should. Oh, it might be too late. So here's the first part, Harrelson. The first part was just a little bit more steps. Yeah, that was that rule. That was we talked about this in class, right? I just said that I didn't say the provision in class, but I just said to you guys in class, when you're leaving Canada, real property is exempt from the deemed disposal rule. And the reason that is because Canada has a whole audit process that non-residents must go through if they sell real property in Canada. So because of that special audit process, they don't automatically deem you to dispose of real estate when you leave Canada. 128.1 bracket 4, that's just a specific citation for that rule. So I'm giving it to you here, but it's again, this was that wasn't necessary. I don't necessarily care to see it in the homework. It was just more. This is just more for your information. No, because real property is considered a high value asset. So the audit process that they created just for real property for non-residents gives the government comfort that they're going to get their fair share of tax. Like, think about it. Imagine you leave Canada. So say you had property in Vancouver 10 years ago, right? You leave Canada 10 years ago. So now you've left Canada and yeah, you're deemed to dispose, right? So you have your capital gain. Okay. If you don't have an audit process, it's hard to let's say 10 years later, now that property is sold. Obviously it's gone up in value by quite a bit. It's hard for the government, the government might not necessarily be on the lookout for these type of disposals. So by putting in place these audit provisions in the Act and forcing non-residents to apply for the sale, but having that as part of the process, that gives them comfort that they're going to get all the taxes they're owed. And part of it is with real property, yes, it is situated in Canada, right? So they're always entitled to tax it. It's not necessarily an asset that they'll completely lose sight of, but that is part of it too, I'm sure. No, it doesn't have just any real property. But the reason this is there is partly because of the fact that real property is generally considered to be valuable. Like it's more around the purpose. It's not part of the criteria. It's just if it's real property, that's the criteria. But in terms of why that rule's in place or why they've done it the way they have, it's partly because real estate is valuable. It's why they put in the audit process around real property. Okay. Anyways, are you good on the question itself in terms of looking at your work and making sure you've got it down properly? And by the way, is there anyone else here in chat that have questions, or are you guys all good?